Okay. So we're based out of Dallas, and like I said, we're building a world-class portfolio of marinas. We acquire off-market marinas, mostly in the south and southeast parts of the U.S., although ultimately we do plan to expand to most freshwater inland lakes across the U.S. And so around 3 years ago, our team identified an opportunity within aquatic real estate. As you all know, about 15 to 20 years ago, multifamily really started becoming a huge opportunity since properties could be acquired for double-digit cap rates and then consolidated and then sold later for single-digit cap rates. Then fast forward, the next segment to see that type of consolidation opportunity was self-storage, and then after that, senior housing. We really believe that marinas are the next asset class to see that within commercial real estate. A couple main reasons why. There's a large consolidation opportunity available. So, for an example, the largest consolidators of marinas in the country right now own less than 3% of the total 10,000 marinas in the country. And they're also reserved for institutional money. So, up until recently, retail investors have not really had the opportunity to get into this space and participate in the cash flow and the upside. Also, over 90% of the marinas in the country are owned by mom and pop operators. So, of course, they're just running them as a lifestyle business in most cases. And when they're ready to retire, oftentimes they're not able to pass it along to their kids. And we show them a nice way to exit and still keep their employees in place and keep that legacy continuing on. Second main reason is over the last few years, COVID really accelerated the supply and demand for this industry, mostly because a lot of new boat owners entered the marketplace, a lot of new boats were sold. So we'll go over some of those data points in the presentation. But what it's created is a lot of supply and demand issues for the marinas. It's not very easy to just go out and build another lake or develop a new marina from scratch. So what boat owners are left with is needing to wait for the existing marinas to expand their properties. And because these mom and pop operators are really just, again, running it as a lifestyle business, when they're approached with adding 100 wet slips to their marinas, they may not have the capital or even the interest in doing that. And oftentimes they can't pass along the business to their kids. So we go in and we find off-market marinas from these mom and pop operators. The nice thing is that just like most mom and pop operators, they oftentimes have a lot of sticky notes all over their offices and 19 to 20 different spreadsheets that contain all of their 16-digit credit card numbers and tenants and all the wet slip details. So they're running these processes very manually and very archaically. And so what it allows us to do is purchase these at a discount at double-digit cap rates because oftentimes they're not recognizing all of the revenue that they could be. And more often than not, they have a lot of expenses that they really shouldn't have on the books. For an example, sometimes they'll have 30 or more people in their family that they're paying for the cell phone bill for. And other things that they're not wanting Uncle Sam to necessarily see. So that allows us to value the business at a lower amount when we buy it from them. In fact, our two current assets under management we actually acquired for an 11.5 cap rate about 18 months ago. And the proposed asset for the single asset fund that I'll share with you, we're actually going to acquire closer to a 10.5 cap rate, and it's a Class A fully occupied property. So we'll just go through. Of course, got a little disclaimer here as always. And I'll kind of bounce around a little bit, but real quick about our management team. Matthew Layton is our CEO, Dallas Hayden is our president, Josh Conley is our COO, and of course I'm the director of investor relations. We've all been doing what everyone on this call has been doing for a number of years, which is raising capital across multiple asset classes in commercial real estate, including multifamily and the like, and then also business expansion in oil and gas. Out of the I'd say 52 to 53 combined years that we've been raising capital as a team together. We've never been more excited about an asset class than we are right now. So I'm excited to share the details with you. So as I mentioned, the largest marina operator in the country owns about 1.6% of all the marinas, and the top two own less than 2.5%. Those are both institutional players. And so there's really not been an opportunity for retail investors to get involved in this space. Anytime that we look to acquire a property, our target entry cap rate is 9% up to 12%. So our two current assets from a previous offering, we did acquire them at an 11.5 cap rate, July of 2022. Since then, we've actually sent out 5 consecutive quarterly distributions to investors, totaling 10% a year on their money before any upside and also before any true expansion efforts. So we've actually not added a single additional wet slip to those 2 properties. One of them would be considered about a B plus class property if you're comparing it to multifamily, and the other one is a C property. Now, what's different about the offering that we have right now is in year 1, we do plan to add 50 to 100 wet slips and increase the restaurant and bar component. So I'll touch on that shortly. Anytime that we bring a deal to investors, we're looking to provide them with at least a 25 to a 35% IRR per year. And our projections are based on some pretty conservative assumptions, which we'll talk about today. Now, in 2020 and 2021 alone, 800,000 brand new boat owners entered the marketplace. And then in 2022, 250,000 brand new boats were sold to boaters. So what that's created is now more than 70% of the marinas in the country are 95 to 100% occupied. And most of them also have long waiting lists of 100 to 200 people or more. Of course, you can't just build more lakes. And like I mentioned before, most of the mom and pop operators are not wanting to really go through the construction and efforts needed to add those wet slips. So that's where we come in. This number here of 100 million Americans going boating every year is pretty conservative. We would say it's actually closer to about 130 million, but most people will at least get out and get on the water, and boat owners actually use their boats on average 4 times per year. So what happens is they'll consume all of the other services that the marinas offer when they come out and enjoy the lake, like the fuel that they'll need to put in the boats, the ship stores, the restaurant and bars, so that they can fun and eat and drink while they're visiting their family and bringing them out for the weekend or the week. And also these will have RV components as well. So people will park their RVs there year-round as well as their boats. Yeah, so most of the marinas that we look at are going to have anywhere from 6 to 8 revenue streams. So it's kind of like multifamily on the water, but with more than one income stream. Obviously, the bread and the butter of the business are the long-term rents, which are had from the boat slip fees and the RV sites. So anytime we acquire a marina, we're looking for at least 40% of the total revenue to come from those 2 sources, where people are signing 12-month leases, they have rent increases each year, and they're planning on continuing to pay, because if they move their boat or if they stop paying for a month, we'll fill that slip or that RV site within hours because of those long waiting lists. Now, the asset that we're proposing for this single asset fund is actually generating just under 58% of its total revenue from the boat slip fees and the RV park. In addition to that, they have restaurant and bar components, as I mentioned, the gas, ship stores, so they buy apparel, sunglasses, cameras, food, snacks, and then most of them also will have repair and maintenance on site, and a boat club that will implement to charge an annual fee for some additional perks. We're even going to be launching a fractional boat ownership club similar to a timeshare. That way people that actually don't have their own boat can have access to a boat 4 weeks throughout the year. And that way we're not only collecting the fees for that, but then when they come out and enjoy the water, they'll pay for gas, they'll go to the restaurant, they'll rent some kayaks or jet skis. And if they don't own a boat, they can also rent pontoon boats. And these will also have some vacation rentals, houseboats, or cabins, or all 3 of those on site. So one of our current assets has some cabins that actually rent for $5,200 a week in the peak season, and they're always full. Come back to this slide and show everyone how you can structure a deal for your investors to show them at or better terms in case they came to us directly by going through you with our Marina class tier. Now, we've talked with a lot of hedge funds, private equity firms, and institutional buyers, and what they're looking for generally is 5,000 wet slips, or in other words, kind of like units in multifamily. Once we achieve that, then we can look for a pretty nice exit. Our projections are generally based on a 6 to 8 exit cap rate. However, our internal goal is to achieve a 5 to 7 exit cap rate on any property. And again, we're acquiring them from a 9 to 12 cap rate. So the idea would be to operate these for a handful of years and then package them up and sell them. Now, one of our current assets that we've owned for just under 18 months, we actually just received an unsolicited offer for sale. Even without adding a single wet slip, we've just improved the operational efficiencies. In fact, we saw a 30.39% increase in NOI in just the first year of operations. And if we were to accept the offer, of course, we acquired it at an 11.5 cap rate, but it would result in a 7 to 8 exit cap rate and meet our pro forma objections without actually any true expansion efforts. So we're very encouraged by that, just 17 and a half months after owning it. And then our acquisition criteria is based on at least 150 wet slips, but most of the properties that we look at are going to have 300 to 600 wet slips each with the ability to expand. They'll also have dry storage and an RV site component and a waiting list, 300,000 in population nearby, and some other components that we look at. And so the asset that we're proposing for this single asset fund was just named the #1 marina in Knoxville, Tennessee, even though it's an hour north of there. It's called Stardust Marina. And the current owner just put a 10% rent increase in place. After that gets factored in and we look at the final 2023, should acquire that property around a 10.5 cap rate. And there's 21 marinas on Norris Lake. All of them are at 100% occupancy. Stardust Marina is in the top 3 as far as rent amounts. So it's got some of the highest rent, and it can command that because a lot of people like to go there. It is a Class A property. It already has the restaurant and bar component. There's 500 wet slips there right now. And let me just get that area here. And we already have approval to increase that to 750 wet slips. So there's a waiting list right now of over 150 people, as well as increase their seating for the restaurant and bar, which normally is the 3rd top revenue producer for the marinas. So it does have 7 profit centers, and I'll show you a breakdown of all of those here in a minute. Right behind that, we have a lot of other marinas that we're doing underwriting on, and the next closest one is on Lake Texoma, in Texas, which is about an hour north of Dallas. That one has 600 wet slips, and they have 200 people on a waiting list. What we would do with that property is cover their uncovered slips and immediately fill that waiting list and recoup that CapEx investment in about 9.5 months of rent. And also it is 1031 eligible, so keep that in mind. Real quick, these are the 7 different revenue streams. Again, boat slip fees are always #1, gas sales are 2, and then the restaurant and bar component generally falls 3rd as far as how many, or the revenue generator. So as far as the projections go, our pro forma is based on anywhere from a 7 to 9 exit cap rate. Like I said, I think it's a lot more realistic to look at that 5 to 7, so we do feel that they're very conservative. Additionally, this is based on 10%. And so we're looking at anywhere from over 25% to 38% a year IRR, and the ROI up to 52.78% per year. So let me actually just quickly go back to this slide that shows the different tiers. We do have 3 different. Most of our capital raise partners and fund of fund managers prefer the Marina class tier, 500,000 and above, so that way they can receive a 10% preferred return and a 75-25 sharing arrangement. That way, as investors get involved in their funds, they can offer anywhere from an 8% preferred return and a 65 to a 70% sharing arrangement, and still show an attractive offer for their investors. Let's see if I missed anything. One last thing I just want to touch on is I think the year 1 and the overall debt coverage service ratio is pretty intriguing. When you kind of look at some of the other asset classes out there, on our base case scenario in year 1, that ratio is 5.35, and over the life of the project, it's 3.17. So just wanted to share that, and I'm happy to answer any questions that you may have.